as president, institutions should be regulated for what they do, not what they are. And whether you call yourself an investment bank, a commercial bank, a hedge fund, a private equity company, or Donald Duck, you should not be allowed to escape the authority of safety and soundness regulation and prudential regulation. Now, what does that mean in practice? Well, it means that all of the elements of the system that failed need to be brought under public scrutiny. And it's not just greater transparency. There need to be some outright prohibitions. It's not just better supervision. I think there are some institutions that are better off as public institutions. Exhibit A is the credit rating agencies. The corruption of the rating agencies was at the absolute center of this whole mess. If the rating agencies had not blessed toxic junk with AAA ratings, a lot of this meltdown would not have happened because investors relied on the ratings. The law itself referenced the ratings. The rating agencies, which are private profit-making institutions, were surrogates of the government because the government required in certain fiduciary situations that you could only buy investment-grade securities, and yet it relied on institutions that were easily corrupted to provide those certifications. And there's a big debate going on about how you change the compensation formulas. I think it's much simpler if you just make them public utilities or nonprofits. I think having basically bought much of the banking system, we might as well buy some of it outright and nationalize a bank or two. Or if we don't do that, at least have a government agency behave like an owner. In effect, the government owns about 60% of the value of Citigroup, but the government has almost been dainty in its reluctance to look very hard at what Citigroup is doing, much less to tell it what to do. And if you compare the way the auto industry is being treated with the way the banks are being treated, it's just a scandalous double standard. No heads are rolling, no compensation formulas are changing. And if we're going to own this mess, we might as well exercise some of the perquisites of ownership. That may well require the creation of an agency that's kind of a cross between the Reconstruction Finance Corporation of the 1930s and the Resolution Trust Corp of the 1980s, so the government has the ground troops to go in and actually see what these banks are doing and, in extreme cases, actually run them. The closest we come to that right now is when the Federal Deposit Insurance Corporation takes over a failed savings institution like IndyMac. But IndyMac is about 1/20th the size of Citigroup, and IndyMac was about as large an institution, maybe a $30 billion institution, as the FDIC could possibly go in and take over, because the FDIC can only spare about 150 people. And Treasury doesn't have people at all. It either subcontracts this to private investment banks, or it just lets the beneficiaries do whatever they want. We need a very hard look at the so-called self-regulatory institutions, such as the one that Mary Shapiro has headed. A lot of this authority ought to be taken back to the SEC itself. Another one of these self-regulatory institutions, the American Institute of Certified Public Accountants, completely dropped the ball on the accounting scandals of the 1990s. That's why the Sarbanes-Oxley Act had to create the Public Company Accounting Oversight Board, and maybe you need something like that as an intermediary institution so that you don't let the stock exchanges of all people be responsible for regulating broker-dealers. We need reserve requirements at every stage of the game so that if you create an exotic derivative that has the power to take down the whole system, you have to hold reserves against it. we need compensation reform across the board so that you don't have incentives to gamble with other people's money and be long gone when the instrument that you've created crashes. More broadly, we need to shift the burden of proof from the creators of exotic, dangerous securities to demonstrate why they add anything to economic efficiency, why they're needed, what it is that's broken that they're fixing. In the past 30 years, the burden of proof has been on those who would constrain this innovation. I think after the crash, the burden of proof ought to be on the innovators. And the idea of a product safety commission for financial products might help, but it's no substitute for direct regulation. My favorite quote of this entire episode was from a talk that I heard by the governor of the Central Bank of India, Dr. Yaga Reddy, who was giving a talk at a panel that I was on at the UN in November. And he said, we're a poor developing country. We don't go in for these exotic securities. We leave those to the advanced countries who understand them better than we do. And I said to him, are you perhaps available to consult? And India has been spared the kind of meltdown of its financial system that we've had because the Indian Central Bank, which is also the main regulator, just prohibits this kind of securitization without reserve requirements. Point is, this is good for the real economy. The counter-argument is, well, if you stop all this innovation, it's bad for efficiency. But if you think about it, what we've had during the past 15 years is a very toxic combination of very low real interest rates with almost no regulation, which is an invitation to financial engineering to use those low interest rates to speculate